Good morning. This is Dylan Jovine with Behind the Markets. Happy Wednesday. Today is Wednesday, March 25th. Everybody has been talking about the price of oil. Everybody is focused on where Brent crude oil is or West Texas WTI oil is. Everybody's focused on that. And everybody thinks that whenever that goes above 110 or 115, that the stock market sells off. Look, amateurs are studying the price of oil that way. Professionals are actually looking at the real biggest threat to the stock market and to the economy writ large is the price of the 10-year bond. And we have talked about this many, many times on this channel. The 10-year bond is a benchmark, meaning that a rate above 4.5% increases borrowing costs for all types of, basically everything in America, consumers, businesses, even the US government, for all the debt. It's just unbelievable. So 4.5% is the magic number. And remember something, this is very, very important for you guys to remember. Stocks and interest rates have an inverse relationship, like a seesaw relationship. When interest rates go up, stock prices go down. All asset prices go down. When interest rates come down, asset prices go up. So right now, when you see that 4.5% rate, that yields start to go up, that exerts immense pressure on the stock market. It's a gravity. It's pulling it down. When that 10-year yield goes below 4.5%, the market starts to go up. This is where the real action is. And if you don't believe me, consider it this way. The bond market's bigger than all these other markets. I mean, a bazillion times bigger than the stock market. So the 10-year yield now is literally up 45 basis points since the war began on February 28th. Now, this is very similar to the surge we saw right around Liberation Day last year, Liberation Day in April 2025. And remember something, President Trump came out guns ablaze on Liberation Day, but as the 10-year yield surged above 4.5% in April 2025, the president began to float a potential pause. He started talking about a pause all of a sudden. So it's like the bond market. I think James Carville said it when Clinton was president. I want to come back when I die and come back as the bond market. It's like everybody's boss. It's true. Once the 10-year yield broke above 4.6%, those of you who remember, President Trump really started to officially implement his 90-day pause. It kind of blinked, or his pause on the reciprocal tariffs on April 9th. 2025, and then the stock market rallied very, very, very well. So it's actually, the price of oil is important. I'm not trying to minimize that, but the price of a 10-year bond determines everything. Now, what makes the price of a bond go up? Oil is one of the inputs. If producers are spending more on their inputs, producer prices, airline, for example, spending more on oil, trucking company, spending more on gas, that pushes yields up. That's inflationary. Okay, so it's telling you that this rise in oil prices is very inflationary. It's really pushing up the yield. So with the 10-year yield now up to 4.4%, it seems like the 4.5 to 4.6% range will be Trump's line in the sand again. And the U.S. economy cannot handle a 10-year bond with a 5% yield. Just to give you an example, house buying basically freezes. A sustained, oh my goodness, it would add to our interest payments, even to our interest payments, hundreds of billions of dollars. Literally, it would choke us. Basically, that 5%. Think about it like, remember, we've been warning about the U.S. fiscal situation. We keep pushing out all these short-term loans. We keep borrowing money short-term. A lot of those things are based on 10-year bonds. And right now, if we see that yield go up, that just raises our cost of selling new debt. So one estimate by the Bipartisan Policy Center says a sustained 20 basis point rise in the 10-year, just 20, could add $702 billion to net interest payments over the 10 years. So that's $70 billion a year in new interest with 20 basis points, which is 1/5 of 1%. So we went from 3.9% here to 4.4% right now. We've already seen a $1.4 trillion jump, $140 billion a year in additional renting just for the government. We're not even talking about citizens who pay mortgages, who are trying to buy houses. It makes everything more expensive. So keep an eye on the 10-year bond yield. Keep an eye on that. That is going to tell you a lot more than anything else that's happening. This is why UK yields have spiked, and we've seen yields spike all over the world. That is going to tell you more. That is signaling serious inflation. And that really, remember, the Treasury has to roll over existing debt at these higher rates, basically, which locks in expensive payments. And the big risk here is this kind of dangerous debt spiral that we talk about. We keep refinancing $7 to $10 trillion of debt every year. And the higher the rates, if we have to borrow from the credit card lender at 30, 40, 50%, it's game over for the United States. So we are in a very delicate situation here, which is why this is so important. Keep an eye on the 10-year yield. That's all I have for you today. Have a wonderful day. See you tomorrow.